Hello and welcome to this episode of Mic'd Up. I'm Pete Seyler, a part of our business development team here at iCM, and today I'm joined by Mike Paciotti. Mike is iCM's Chief Investment Officer. Mike, thanks for joining us.
Glad to be here, Pete.
So today we're going to kick off with a couple of rather timely questions. For the last few years, what we've seen is investors really benefiting from tilting toward cash. Do you think now is a good time for traditional bonds?
So it's interesting because I think that's the common view because investors were really so burned by 2022, but it's actually not the case, at least since then, right? So entering that year, 2022, that being, we identified that perhaps the most difficult problem in all of finance was actually generating a return for a conservative investor, right? In fact, our third quarter 2021 Market Insights was titled just that, mainly because bonds were so expensive.
Sure.
So in fact, bonds were actually priced to provide about a 1.5% rate of return annualized for the next decade. And what ultimately happened was 2022 reset all of that, right? The direct result of probably the worst bond market on record as rates rose from 50 basis points to about 5%, and bonds declined by what was a record 15% peak to trough.
Yeah, that was around the time that, really many began to question if bonds even belonged in portfolios. And, after all, it's a valid question because they didn't really protect you in 2022, as so many thought up to that point.
Yeah, it's certainly a natural response, but it was actually the wrong thought process, right? So from that date, the Bloomberg Ag has actually gained around 10%, surpassing the almost 9% gain on cash. Now, we've been, as you know, been banging the drum for bonds really since early 2023, and then certainly again this year after our brief inflation scare this spring. In fact, since then, bonds have gained a little over 7% versus the 2% on cash.
Got it. So what about now?
Well, we're definitely less enthusiastic about bonds now. They aren't the slam dunk that they were just a few months ago. So when you think about it, a 7% gain in 4 months will probably do that to you. So if we take what many are calling the neutral Fed funds rate at 2.87%, the reason that we've cooled just a little bit becomes kind of more apparent, right? So at the nadir for bonds, both the 2-year and the 10-year Treasury yield exceeded 5% yields versus 3.6 or 3.7% today. So at its worst, right, those yields were very attractive, and today much less so. So if the neutral rate is in fact 2.87%, and the 2-year tends to match Fed funds over time, the 2-year is now only 3.6%. You have another 70, 80 basis points of easy sledding on the short end of the curve. Now, the 10-year typically trades about 84 basis points above the 2-year. So the 10-year is actually pretty fairly valued right where you are, unless you actually believe that you're going to end up with a recession.
So why do you think that is?
Well, in a recession, the Fed will blow right through the neutral rate into stimulative, right? So it's a good possibility but if you're looking for kind of just to swing at fat pitches, I'm not sure that you could call a recession prediction a fat pitch. We believe that it's likely, but it's hardly inevitable from our vantage point.
All right, so let's kind of stay with the overall theme. What you've heard a lot of in the financial media, and many think this may be a good time to purchase either investment grade or high yield bonds. What's your view on this?
So it's funny, that's what kind of makes a market, right? A divergence of opinions. So respectfully to those that are in this camp, we don't agree with that. So spreads are about as narrow as they've ever been, meaning the reward for taking risk in those spots is practically non-existent. So quantitatively, it's a no for us. But even qualitatively, if you have any view of recession, credit doesn't really do well in those environments. So, we should see some spread widening, meaningful spread widening in that type of scenario, which, ultimately wouldn't be good for either of those.
Got it. So let's stay timely. In your more than 25 years of experience in the industry, is investor anxiety during presidential elections truly normal?
Well, it's kind of funny that you say that because I'm not sure that we really have that much anxiety at this point, right? Stocks are at near all-time highs, spreads are narrow, rates are falling, the VIX is relatively low. So that's about as priced to perfection as you could get.
All right. So looking at a similar question, do you feel that presidential elections generally impact long-term performance one way or the other?
Actually, no, not at all. So, in fact, over long periods, 5 to 10 year periods plus, you'll likely experience times with all sorts of political influences that extend just beyond the Oval Office. So, if you look at the history of stock performance under Democrats versus Republicans, it's actually skewed by a few events, the internet bubble formation and that aftermath, and similarly, the great financial crisis and its aftermath, each owned really by both parties. So it's pretty hard to determine who caused the great performance or the bad performance, right? If you were lucky enough to follow the internet bubble bursting, you had some benefit, but did you really create that? Probably not, right? So you were just kind of lucky enough to be there for the recovery. And likewise, with the great financial crisis, you had the same type of thing. And if you set those aside, the performance becomes pretty indistinguishable. But in total, it's kind of for lack of a better term, a pretty pointless exercise because of the cause and effect reason I mentioned just a moment ago. Now, what does raise an eye regarding long-term performance is when you start to talk about extreme changes in policy, price controls, or extreme changes to the tax code. So I'm not talking about brackets moving up or down a couple of points, or even the corporate rate moving up and down. What I'm talking about are things like taxing unrealized gains and how that would impact markets, or sizable increases on taxes for dividends or cap gains or share buybacks, right? That may shape the growth value narrative, right? Or even tariffs for that matter, also disruptive to the normal order. All of it can be potentially disruptive if extreme. So during election season, we view it as just banter, mainly noise. And as talk becomes policy, it'll become our job to interpret the impact of those events, just like we did with the corporate tax rate change a few years ago.
Great, Mike. As always, it's great to have you here.
Glad to do it, Pete.
Absolutely. So I want to thank everyone for taking the time to watch this episode of Mic'd Up. If you have topic suggestions or any questions, please do reach out to us at 888-426-4689 or via email at info@icminvest.com. We're going to see you next time.